Hi, folks. We'll start in just a few seconds as everybody comes into the webinar from the waiting room.
All right, so it looks like we have 6 attendees. I'll go ahead and get started here. Hi, everyone, and welcome to today's webinar. My name is Jackie, and I'm with the New Mexico Small Business Development Center. Today, we have Tommy Thompson joining us, who is a certified SCORE mentor who specializes in business and corporate financial planning and business evaluation. Tommy holds an MBA and is a retired CPA and will be presenting expert tips on buying and selling a business. Thanks so much for joining us. And without further ado, I will hand it over to you, Tommy.
Thank you very much, Jackie, and good afternoon, everybody. Thanks for attending today. By way of introduction, I am an analyst, a planner, a strategist, a writer, a speaker. I've been a certified SCORE mentor for the SCORE Association since 2011. I started into that after 40 years of business experience in a variety of industries, doing a variety of different things in different companies. My father-in-law, who retired from a job after 35 years with the same company, used to say it was a terrible thing I couldn't hold a job. And I said, gee, I kind of like it. So that's what we're talking about here. Today, we're going to talk about businesses, buying them and selling them. We're going to talk about a number of things. I want to acknowledge at the start Daryl Arn, who is the president of something called Arn and Company, which is a sell side medium firm advisory company in the M&A world. Daryl was the original author of many of these slides that we're using today, and he works out of Albuquerque. So I wanted to thank him for his origination of much of this material. Today, what we're going to do is we're going to talk about training offerings and counseling assistance from New Mexico Small Business Development Center. We're going to talk about training objectives for this program, and then we're going to talk about this program, which is basically involves the process of buying or selling a business, the concepts involved in how you value it, the steps you go through to develop an idea of how to do the deal and what kind of a deal to do. We're going to answer your questions, and we're going to also talk about next steps from here with what you're going to talk about and learn about today. So for guidance with the presentation, I would like everyone, if you haven't already, to please mute your audio. If you would, make sure to set your zoom ratio to fit window, because that will bring the slides up in their best resolution and also largest typeface. We'll be using the Q&A function to take questions. So if you have a question, write it down using the Q&A function in this little black bar at the bottom of your screen. If you write down your question and the slide title that the question relates to, that'll help me find it as we go back. We'll try and answer questions as we go through the program. I will say that this program was condensed from a 3-hour all-morning seminar. So I'm going to talk really quickly, and I hope you set your listening speed to high, because you're going to need to set it to high in order to listen to me talk this fast for an hour. So I sometimes feel like the Federal Express man in those famous commercials when I get going in this process. Today, talking about training offering and counseling assistance, you can visit the NMSBDC website at that location there to view the training events that are available to you, this being one of them. You can also sign up at the SBDC website to request no-cost business counseling and loan application assistance from SBDC staff. All of those are quite valuable, and I commend them to your review after today's seminar is over. Now, what are we going to do today? What are our objectives today? I want to raise your awareness of the various reasons that a business purchase and sale deal may happen. And it isn't just because you want to be your own boss. There's a variety of reasons. We want to introduce the business transaction process, the steps that you go through, describe those major process elements. We want to provide some basic valuation concepts and a couple of tools that you can use to get a back of the envelope kind of ballpark idea of what a business might be worth. Now, let me say that the valuation of a business for a deal is a very subjective thing after you get done with all of the usual analytical concepts and analytical tools. We're going to offer you some negotiating tips on getting to yes, and then provide some tips for closing the deal or getting her done, as Larry the Cable Guy says. And we're going to try and provide a few minutes to deal with any questions that you might have. So that's what we're out to do. Today, we're going to talk about preparing for a business deal. We're going to talk about searching for a buyer or a seller. We're going to talk about valuation, tax structuring, financing the purchase, negotiating what's called a letter of intent, which is something I highly recommend that all of you use if you're ever going to negotiate a deal, because that's the first time that you put the deal parameters down on paper. Then we're going to talk about conducting due diligence. Due diligence is the process of ensuring that what you've been told is in fact true. And finally, we'll have a few words to say about the closing process that gets you to actually owning the business or selling the business and getting the check. We've got a lot to talk about, so we'll start right out with preparing. Why are we doing this? Why are we looking to buy or sell a business? Your individual motivation as a buyer or a seller matters in this deal because it affects the way you see your business. It affects the way you see your target. It affects the way you value your target or your business going and coming. Now, for buyers, a lot of people want to be their own boss. They want to be independent of other stakeholders, of other bosses. They want to do it because their health situation motivates them to have an individual business rather than trying to work for somebody. The buyer may already have a business, and they may be looking at buying another business either to provide growth in the same industry or synergies such as horizontal or vertical integration, where they're buying a supplier, for example, or buying a retailer of their product, for example. And the buyer might also be a strategic buyer. These are buyers who think that they can use this business as the kernel of something much bigger and are willing to pay a price for that on the way in. For sellers, I'm in the front third of the baby boomer generation, and I've been retired for about 10 or 11 years now. The 2/3 of the baby boomer generation behind me are retiring at the rate of 10 to 20,000 people a day. And a lot of those people own their own businesses. And a lot of those people have kids that don't want any part of the business. So finding a new owner to carry on a business is one thing. And also finding, since the business is the largest single asset that most sellers have, they're looking to fund a retirement account and fund a lifestyle in retirement that appeals to them. Sellers can also be selling because they're burnt out. They may have been a one-man band for 25 or 30 years, and they just don't want to do it anymore. Age and health play a role in that burnout feeling. And in a lot of cases, a seller is selling a business because there's no real identified successor. None of the kids want it. They haven't cultivated or haven't inculated an entrepreneurial spirit in their number two guy or anybody else in the management team of the business that they might have. So there really is nothing for them to do if they want to leave the business except to sell it, find a new owner. You need to be honest about your motivations as you go about looking to do a deal. And if you're honest about your motivations, that will help some things fall into line better and more easily, especially when you get down to the nitty gritty of what are you going to get paid, how are you going to get paid, and what's the seller planning to do with your business. What's a buyer planning to do with your business? Forgive me. I don't know a single seller who hasn't wanted to have things continue running the way they were, more or less, with a business that they were trying to sell because it was successful for them in their terms. And a lot of sellers sometimes try to introduce factors in a deal that won't necessarily translate well into a new owner. So be honest about your motivations. If you're a seller, you're going to be gone. If you're a buyer, you don't want any interference from the former owner. And those will affect how you negotiate a deal. Now, sellers, it's important to start early in your process. 3 years before starting the sale process is when the sale process really starts. It's not about advertising the business for sale. It's not about creating an information memorandum. It's not about retaining advisors and a team. But years before you start doing that, you need to start cleaning the business up for sale. And that means managing it for the maximum amount of cash flow, emphasizing the profitability of the business over perhaps more sustainable capital expenditures, reducing capital expenditures to the minimum required to keep the business going at the level it's at. You want to try and do everything you can to improve the business's credit standing by making it look good to vendors and creditors. And you also want to continue new customer acquisition efforts. Don't stop marketing to new customers. Your customer base will continuously erode unless you replenish it with new customers. And you've got to keep that in mind as you're running the business. So this is really a sprint to the finish. If you've been running your business at a pretty reasonable pace for a long time, now you're in a sprint to the finish. You want to get there, you want to make it look as good as you possibly can, you want to make the financials look as good as you possibly can, all of which will improve the amount of money you can ask for the business and hope to negotiate and get. Now, in line with doing that, do your own due diligence on your business. Try to look at your business as if you were going to buy it. And what do you need to know? And make sure you collect and gather that information so that a buyer can look at it at the right time in the process. At the right time in the process is not when their first inquiry comes in. All right, we'll talk about more about that later. You want to work on having exceptional customer relations. You want your customers to think well of you and say good things about you. You want a well-trained and well-motivated workforce. And motivation is more than just the amount of cash you're paying them. It's the entire workforce environment. It's not within our scope today to talk about effective human relations, but that is one of the things that's important to a buyer, is to have a well-trained, motivated workforce that most importantly is going to stay when your buyer takes over. You want to make sure your equipment and business systems are in good working order. You want everything to be producing in accordance with its specifications and in accordance with its capacities. You don't want things showing breakdowns all the time. Those things need to be in good working order. That may mean that you need to invest a little bit of capital expenditure money to replace that machine that was on its last legs. But that's what's necessary. You want the plant, if you're producing things, manufacturing things, you want that plant to be manufacturing as intended. You're going to want your CPA or your tax preparer to produce 3 to 5 years of financial statements, real, official, prepared according to generally accepted accounting standards, financial statements with notes and schedules, okay? Because any buyer is going to want to look at those financial statements. You might even have your CPA prepare an overall summary of the profit and loss, balance sheet, and cash flow statement of those financial statements. All right. Now, you also want to invest in income taxes. What do I mean by invest in income taxes? You want to make sure you've paid the right amount of tax, no more than the right amount of tax, but no less either. By doing that and by being sure that you're on firm ground with all the positions your tax preparer and you have taken in your income tax returns, you'll have the better chance of a clean deal. In other words, you've got obvious compliance with all the relevant taxing authorities that you owe taxes to. That's not only your state and federal income tax organizations, it's the state sales tax organization, it's the labor department for payroll and payroll tax stuff. It's also your local jurisdiction for property taxes, that all of those are fully in compliance. Because having them not in compliance won't necessarily kill a deal, but it delays it. And a deal delayed is a deal in danger. All right. You don't want to have odd things popping up in the middle of the deal, because those things, even though they may be easy to fix, those things give your buyer, your counterparty, ideas. Maybe they're not attractive ideas. Okay. Finally, you want to clear up any and all litigation claims, whether it's actually proceeded to a lawsuit or it's just a claim made to your insurance company. You want to get anything of a legal nature settled before you start talking to buyers, okay, if you're a seller. Now, along with that, anything else that is necessary, and there's a bullet down here at the bottom, which will be on the copy of these slides that you get. Um, any other facts, any other circumstances that affect the deal that could have an impact on the deal with them, get them organized, get them out of the way. Okay. Sometimes this doesn't want to go forward. There we go. Once you've prepared and done that, and your first step in the process as a seller is to produce a marketing package. Now, this doesn't apply only to sellers, it also applies to buyers. From the seller's side, you want to create an information memorandum that tells the story of the business, provides a financial overview without providing too much in detail, and presents the business in its best light without misrepresenting any facts. All right. That's a straight information package. This is the business. This is what we do. This is who we do it for. This is how we find customers. This is how we service customers. This is how we finance things. Okay. For a buyer to appear credible to the seller, a buyer needs a resume that shows that they have either the functional skill set or the industry skill set to actually operate this business if they were to take over. And we'll find out why that's important to the seller as we go along here. The buyer should also produce a financial statement that indicates that they have some financial capacity to participate as an investor in the deal. The buyer should produce a credit report that can shed light on their ability to meet their obligations as they come due. And the buyer should also have the beginning, the outlines at least, of an operating plan. This is how I'd operate the business. All right. And while that operating plan doesn't necessarily need to be shared with the seller, the buyer needs to be thoroughly familiar with it because at some point the buyer will be talking to lenders, financing organizations about the business, and they'll need to have some way to talk about an operating plan. This is how I'm going to make the business as successful or more successful, preferably, than it's been in the past. Because I'll tell you, the business is going to have to be more successful than it was in the past if you're going to pay the price the seller wants for it. All right. We'll talk more about that too. Now, for sellers, you're going to assemble your records. You're going to need to assemble the things that a buyer is going to want to look at the stage of examination called due diligence. That stuff includes financial statements, tax returns, and the tax returns should reconcile pretty easily to the financial statements. If they don't, have your CPA produce a reconciliation. Organizational documents, what kind of legal entity is it? How has it been maintained? Key staff descriptions, what are the key people in the business? Who are they? What do they do? Contracts, leases, litigation records, any outstanding litigation that you can't clear up, you're going to have to disclose and talk about, so you might as well gather those records together. Corporate books and records, what have the minutes of the corporate meetings looked like? The corporate books, who has actually been issued shares in the business, okay? And then finally, customer information. Who are the customers? What percentage of the business are they? How well do they pay? What do they buy? What is their prospects for buying more and or different stuff from you in the future? All that is going to be important things for a potential buyer to review at the proper time in the deal steps. Okay, so you got to get this together. And you can see why it can take 3 years, because gathering this stuff together where it might be lying in a dusty banker's box in your back storeroom and organizing it in a logical fashion so somebody can review it quickly, because again, you want them to be able to review things quickly, is a very important thing, necessary thing to do. Now, you also, both buyers and sellers, have to put together a team to do the deal. Buyers need a lawyer. Sellers need a lawyer. What do lawyers do? Lawyers protect your individual interests in a deal. It's up to the buyer and the seller to develop the business deal. Okay, how much, how are you going to pay it, when are you going to pay it, okay, and the outlines of any of the other business terms of the deal. It's the lawyer's job to put those terms and protections for both sides into the definitive purchase and sale agreement. Both sides are going to want an accountant slash CPA, somebody who has the skill, knowledge, and experience to be able to tell both the buyer or the seller what the tax consequences of their purchase is going to be. If you're a seller, the tax consequences of how you sell the business, in what form, can be pretty significant. And you want a CPA to advise you on that right at the outset, so you can set some parameters at the outset and not get halfway into the deal and say, oh, we need to do the deal this way instead of that way. All right. Now, a lot of people gig me on this and say, well, you were an intermediary once upon a time, which I was. So that's why you recommend a broker or intermediary to both sides. Let me ask you this question. How many times in your life are you likely to buy or sell a business? Unless you're a serial entrepreneur, you're only going to do it once or twice. Wouldn't it be worthwhile to have available for consultation somebody who hasn't done it just once or twice, but has done it dozens and dozens of times for different clients? The experience that a business broker or an M&A intermediary brings to the table is one that can make the whole process flow more smoothly. It can make the valuation a less emotional, less subjective topic to discuss. And in general, they're the kind of people that are worth what you pay them to shepherd the deal along to conclusion. All right. People have done deals without a broker or an intermediary. Okay. I'm very familiar with having pitched the firm that I was with in the 90s and the noughts. I'm very familiar with having pitched our services to people who say, oh, well, here's the logical buyer. I'm just going to go sell it to them. Well, okay. And they did, by the way, and got a handsome price for it. Did they get the best price they could have gotten? Did they get the best deal they could have gotten? I don't know. They didn't use us, but I asked the question. Buyers, you're going to need a financing source. You're going to need someone that, or a bank, or someone that is backing you up, because it's very, very rare that a buyer can raise the entire purchase price of a business on their own hook, right? For sellers, you need a financial planner on your team, someone who will advise you on what to do with that big fat check you take away from closing, and where and how to make it last for your entire retirement and leave something behind for your kids. All right. That's what financial planners are good at. The structure of any deal, the structure of any deal's financing and the payment to the seller varies, but there are some common elements that we'll talk about. And in those elements, the way those elements are taxed also is an issue, which is why your accountant or CPA can continue to advise you on how the proceeds are invested by your financial planner and taxed, right? Now, then you got to go looking. Sellers, you have to go looking for a buyer. Buyers, you have to go looking for a business. And where do you go? Well, you could use a broker or intermediary. Lots of business brokers operate like real estate brokers. They have a stable of listings at any one point in time. They have access to what amounts to a business broker's multiple listing service. Intermediaries, mergers and acquisitions intermediaries, I distinguish between the two because intermediaries generally deal with larger businesses. Okay. You can use either one of them to look specifically for you. They, in their turn, may use trade association publications. Often there's a classified section in there of people in that trade association who want to sell a business or buy a business. You can look for referrals from local attorneys, local CPAs. You can look in the newspaper. Wednesdays, the Wall Street Journal has a business opportunities section full of little tiny ads that basically give the kind of business it is, roughly what region of the country it's in, and an email address to respond to. And that's just a very, very small ad. I once did a deal where we sold a tourist attraction and we placed a very small ad in that Wednesday Wall Street Journal business opportunity section and said tourist attraction, Northeastern US, uh, single digit million revenue, and here's an email address to respond to. And we took those responses, and that began the conversation because we could sort out who the responses were coming from and which we wanted to respond to and which we didn't. Because you can often tell in the way somebody talks in a response to an ad whether they're who you want to deal with or not. The internet these days is the big place to go, and you can just Google search businesses for sale or businesses to buy or buyers looking for businesses, and get hundreds of, if not thousands and tens of thousands of hits back. Also, don't forget, if you're a seller, don't forget your competitors because your competitor might be the best customer for your business. Now, a lot of business people are very leery about approaching a competitor or how to approach a competitor. Often, this is another value that a broker intermediary offers is that they can approach a competitor on a completely blind basis by saying, we're aware of a business in your industry that's for sale in the same general geography that you operate. Are you interested in some more information? And now with competitors, there are a couple of steps you have to take in advance. With everybody, you're going to want a gentleman's non-disclosure agreement about your initial conversations. A more formal agreement for confidentiality will come later. But it's more important with competitors that agreement might be a little more complex than just a hi, we're all gentlemen here. You're not going to tell anybody you're talking to me. I'm not going to tell anybody I'm talking to you. And if we exchange any information, it's solely for this conversation, and neither of us are going to use it for any other purpose. That's the usual gentleman's agreement, non-disclosure agreement. With competitors, you might have a little more formal confidentiality agreement that a lawyer might have created and passed on before you start more serious conversations. Some internet sites where you can find things. Both business brokerage companies have their own websites. IBBA is the International Business Brokers Association. That's their website. MA Source, Mergers and Acquisitions Source, that's their website. BizBuySell.com, that's just a listing site. FirstList.com, same idea. DealStream.com, same idea. All of which are carrying lists of businesses for sale and also ads from buyers seeking businesses. All right. So both sides of that can be satisfied there. Now, a seller's major concern in the process is that, quote, word will get around that I'm selling and my customers will go to my competitors. Another concern is that a competitor will steal my business by telling all your customers that he's selling out, you should come do a deal with me. They're afraid of competitor reactions to a competitor knowing that the business is going to be for sale. Those are all addressed in that somewhat more formal confidentiality agreement that I talked about a minute ago. Now, here's another conversation about using an intermediary. Buyers and sellers can use an intermediary and preserve their confidentiality. The intermediary can work and the process is blind to the other side until the point in which you decide to reveal it. Similarly, they're experienced in preparation and process. They have resources and networks. They have vast experience in structuring and negotiation techniques and tactics. They know what market conditions are because they're in that market all the time. This is a time-consuming process, and having an extra pair of hands actually doing things for you can be valuable.
So Tommy, we have a question in the question and answer.
Yes, okay.
It's from an anonymous attendee, and it
Does
says,
age matter when purchasing a business? I'm in my 60s. I'm looking to start a business. I'm thinking of purchasing one. Okay. Age matters. Let me tell you why. When you go out to start a business or to buy a business, all of your time and more will be consumed in that process. are you energetic enough to expend that amount of energy, that amount of time, every minute of every day for a year or two or three in getting a business off the ground or getting effectively operating a business after you buy one? All right. That's a question for you to ask of yourself. When you're 30, things look a lot more doable in some cases than when you're 60. All right. I know I found that in my own life. I'm 70 this spring, actually last fall. And I don't have the same level of energy for certain kinds of things that I once did. And you're going to have to assess that question for yourself when you're looking at the business. Now, does age matter to a seller? Will a seller consider selling a business to someone of a certain age? All right. That's another question that the seller has to answer for themselves. Is this person capable of operating my business with the commitment and the time necessary to make sure that my seller financing gets paid off? Okay. So there's an issue, there's a potential issue with the seller's assessment of your level of energy. It works on both sides. So those are questions that you have to answer for yourself. I'm not saying that you're too old to buy a business. I'm not saying that a seller will think you're too old to buy a business. I am saying that those are questions that have to be answered early in the process for yourself as a potential buyer, and you have to be able to assure any sellers that you're a fairly long-term buyer. You're capable of not only paying out the purchase price, but also capable of operating the business into the future, so that the people who work there continue to have jobs. Sellers can be quite attached to their workforce, and you want to be you want to be sensitive to that. So I hope that gives you some perspective on your question. There's no hard and fast answer. It's a matter of your own assessment of your own energy level, and it's a matter of the seller's assessment of your intentions over the time. Finishing this up, intermediaries can help you temper emotions, because both sides of a deal, the seller and the buyer, we being human beings, we're emotional beings. And a more disinterested intermediary who's looking at this as one of a whole series of clients they've had over the years may be able to help you control and temper your emotions a little bit as the process goes on. Intermediaries have experience in valuation. They have experience in evaluating valuations. And we'll talk a little bit about professional valuation after a while. So they can help put some perspective on where value lies in a business. And finally, intermediaries have networks of lenders that they've worked with in the past. They have an assessment of what particular lenders are interested in financing and lending to. Intermediaries can also deal with the competition, again on a blind basis, that confidentiality thing that we talked up on the front. So all of those are reasons to consider the value of an intermediary. The typical intermediary is going to charge a commission somewhere between 6 and 10% of the selling price of the deal. That's the total value exchange in the deal. They'll want to get paid at closing for that, and you're going to want to assess the cost of that against the value against your own experience as to whether you could go it alone or whether you're better off adding an intermediary to your team. There we go. Let's talk about value. Now, a professional valuation of a business is done by a trained professional valuation analyst. And these are people who are putting their personal reputations on the line in offering an opinion of value, much the same way that a CPA offers an opinion with respect to the financial statements that they've audited. Now, there are a number of reasons to do a valuation. They include mergers and acquisitions, partnership and investor breakups and startups, startup financing and planning, divorce, estate taxes. The IRS requires a valuation of a business that's included as part of an estate. You can also do a valuation in advance as part of insurance planning or estate planning, to give you an idea of how much insurance to buy if it's a key man insurance situation, or how to plan for the estate and its distribution in that far off day, hopefully, when you're not around to do it yourself. Now, in transactions, buyers pay for the past, but they're really buying the future. They're buying the future cash flow. Sellers explain the past, but they're really selling that future. It's worth to you as a seller, as a buyer rather, what the seller has made of it. It's worth to the seller what the buyer can make of it. And that's where negotiation comes in. The price of a business lies between these 2 points. Now, our benchmark for valuing a business is something called fair market value. And that's defined as the amount by which a property would change hands between a willing seller and a willing buyer when neither has to sell. Neither is acting under compulsion. That's what it means. Neither one has to sell and neither one has to buy. And when both have reasonable knowledge of the relevant facts. Now, you can see the holes in this as a factual tool to set a price absent negotiation. Because, first of all, either the seller or the buyer may actually be acting under compulsion. The seller knows he has to sell. The buyer is just has to buy something. Okay? And also, it's very, very rare that the seller and the buyer both have the same set of knowledge in the deal. A buyer may know things about the industry that the seller doesn't. The seller may know things about the business that the buyer doesn't. All right? So our fair market value benchmark is an arbitrary construct that we use as just that, a benchmark. This is the uninterested party deal value. And there's a number of ways that that's calculated. I'm not going to go into valuation methodologies here, other than to say that the price may actually be higher or lower than the benchmark fair market value. You estimate the value, you negotiate the price. Now, the key considerations in determining fair market value are the seller's operating cash flow, the value of tangible and intangible assets in the business, both those that are used in the business and those that may be part of the business but not being used. For example, a manufacturing business that owns 1,000 acres of forest land somewhere, that forest land is not too useful to the manufacturing operation perhaps, but it's part of the business. And then the buyer's required return on investment is a key consideration in determining fair market value for a mergers and acquisitions deal. All right. Now, that required ROI can be estimated based on data that's available about the industry and about investors' evaluations of that industry. Other considerations include comparable sales of similar businesses, what it would cost to replace that business, all right, by building it from the ground up, that business's market segments and reputation, its territory rights, if any, and finally, the overall economic environment in which it operates. All those things contribute to fair market value. Now, we're going to talk about a couple of things here, and I figure it's time to talk about some terminology. Net income of the business is the net income the way the accountants determine it. Okay, it's net income according to generally accepted accounting principles. And we're going to talk about that's our starting point for some of the things that we see here in the valuation process. Seller's discretionary cash flow, or SDCF, is the cash flow coming off the business that the seller has discretion as to how to use it. They can pay it to themselves, they can pay it to their lenders, they can invest in growing the business, they can invest in maintaining the business, but that's their discretionary cash flow. It's not needed to operate the business in the short term. Another concept we're going to talk about is cash flow. What is that cash flow comprised of? And we're going to create a proxy for that, which is calculable from the GAAP financial statement, the GAAP net income statement. And that's earnings before interest, taxes, depreciation, and amortization. That's so-called EBITDA. That's a proxy for the operating cash flow of the business. It eliminates interest, which is a function of financing. It eliminates taxes, which is a function of the individual owner's tax situation. It eliminates depreciation, which is a non-cash item, as is amortization. All right? And that gets us down and winnows us down to the basics. What's the business throwing off in terms of operating cash flow? Here's an EBITDA example. The SDCF and the EBITDA are the same down to one particular place. All right. We take the net income of the business, we add back the interest expense, we add back the income taxes, the depreciation, the amortization, and suddenly $100,000 worth of net income is $160,000 worth of EBITDA. Now, in the seller's discretionary cash flow, we are also adding back the owner's salary, the owner's health insurance, the owner's personal automobile expense, and in this case, they happen to own an airplane. I'm sorry, I hold a commercial pilot's license, so I just had to throw that in there. And I've seen a number of business owners who do own their own airplanes. And so the total seller's discretionary cash flow is quite a bit more than EBITDA. This is the way a business broker will, working on behalf of the seller, will present the cash flow. They'll say it's $283,000. Well, a buyer coming in is going to look at that and say, well, wait a minute. If the owner is also the manager, you got to allow for a manager's salary. You got to allow for their health insurance and benefits. Maybe you do or don't have to allow for a personal automobile or an airplane, but you do have to add some of that stuff back in your valuation. This is where negotiation starts to happen. All right. Because the SDCF, as the broker defines it, or as the seller defines it, could be different from EBITDA, and probably will be. The basic valuation formula is that the value equals the earnings, or the SDCF, times some multiple. And the process is to determine that earnings base, evaluate the business's risk, and then determine the multiple. All right? With risk, earnings can be defined in several different ways. The net income per the books, the EBITDA, and the SDCF, which we just talked about. All right? So we're going to start with one of those. The broker's going to want to start with SDCF. The buyer's going to want to start with EBITDA. In either case, if you assess that the business has a higher general business risk than similar businesses, you're going to assign it a lower multiple. All right? And that includes cases where there's less growth or synergy potential between a buyer and seller, or where debt capital is not readily available. Those kinds of businesses are going to command lower multiples. Similarly, businesses that have lower risks, say they're the dominant business in their geography, their industry, or their general category, segment category, they will command higher multiples because they're less risky. Higher growth and synergy potential that a buyer brings to the table. That may improve the multiple they're willing to pay because they know down the road they can do better. And similarly, where debt capital is readily available, a higher multiple might apply because debt capital is relatively cheaper than equity capital is. Equity is your most expensive capital. So all these things go into valuation considerations. There are also rules of thumb or industry averages that are applied based on a percentage of gross sales, some multiple of SDCF, or some other multiple that's based on industry-specific indicators. All right. Back in the days when software companies were getting off the ground and growing rapidly, there was a valuation metric for software companies that involved the number of users of that software, or the so-called number of licensed seats of that software. And that was a rule of thumb. Now, the problem with rules of thumb is that they can be misleading, they can be inaccurate. So while you might consider a rule of thumb, you're going to want to look closely at the specific business to come to a conclusion about its value. Now, this is where we get valuation specialists. They would be added to your team in addition to a broker or intermediary if you needed an independent, objective opinion of the fair market value of that business. Now, these people are credentialed professionals. They could be a CPA/ABV. That's what I am. A CPA, you've all heard of Certified Public Accountants. You may not have heard of ABV, which is accredited in business valuation by the American Institute of CPAs. It's a credential given out to members of the American Institute for passing tests and for gaining experience and for attending specific educational opportunities. CVA is Certified Valuation Analyst, CBA, Certified Business Appraiser, ASA, American Society of Appraisers, or Accredited Senior Appraiser, rather, in business valuation. Those are the most common credentials that you're going to see. You want to make sure your business valuation professional has at least one of those. Some have 2 or 3. They're like merit badges when you're a Cub Scout. You just pick them up along the way. These people can be expensive because if you're asking for their objective opinion, now you're getting into the area that says if their opinion is arrived at in a slipshod fashion, they can get sued. So errors and omissions insurance comes into play here. You got to pay for that, and you have to pay for their risk of offering an opinion. The scope of work that you get from them is critical in terms of developing the cost of that. And the other thing is that cooperation from a target business, if you're the buyer, the target's cooperation may be needed to get a valuation going. So these are folks, if you think you have a need for them, they can be expensive, but there are scope of work considerations that make them relatively less expensive, and you want to explore that with them. If they don't have to offer an opinion, things get much less expensive very quickly. Now, once you've got a valuation figured out, you have to figure out, is it reasonable? And the question to ask is, will the operating cash flows satisfy a number of claimants? Okay, will the cash flow satisfy debt service with a lender? Will the cash flow satisfy Uncle Sam's desire for income taxes? Will the cash flow support the company in terms of its needs for capital expenditures and working capital expansion as it grows? And finally, will the ROI that results after all those claim holders claim their cash, will that return on investment satisfy an equity investor? If the answer to any one of those questions is no, or that the cash flow won't support any one or all 4 of those claim holders sufficiently, then your price is probably not reasonable. And keep that in mind as you're doing the process. Now, the fair deal versus the best deal. The actual selling price of the business will be the result of a give and take of negotiations between the buyer and the seller. It may not look much like the fair market value when you're all done, but the fair market value gives you a starting point. It gives you a benchmark that you can say, well, okay, there's the fair market value, but it's really worth less to me, the buyer, because whatever issues you found. And the seller may say it's ultimately worth more to me as the seller because I see value that isn't adequately accounted for in the valuation study. So it's negotiation, but a valuation gives you a benchmark point. Now, tax structures. Tax considerations in a purchase and sale transaction, I'm not going to get deeply into this because this is what you do with your CPA. But the biggest differential is whether you are, as a seller, selling the stock of your legal entity or whether you are selling all the assets, tangible and intangible, of your entity and then winding it up yourself afterwards. When you sell stock, to the extent that the stock exceeds your basis in the stock, you have a capital gain. Simple to be taxed on, relatively low rate. If you're selling all the assets of your business as a seller, then you have to calculate the recapture of depreciation and amortization in all of those assets in order to account for them properly to the tax man. That recapture gets taxed at ordinary tax rates. Okay? So the seller may pay more on taxes on an asset sale. A buyer gets some tax advantages when they buy assets because they can then appraise those assets to their fair market value and start depreciating them from their fair market value. And they may get a little bit of an advantage in depreciation because of that. Now, also, the seller might get deferred recognition of the gain if there's an installment sale made. In other words, the buyer pays the seller some amount over time, usually several years. Also, the seller might have to recognize interest income on that kind of installment payment, and that's at ordinary income tax rates. A seller recognizes interest expense on those kinds of payments, and that's an ordinary deduction to them. All right. Whereas if you buy the stock, you just buy the stock, and there's no interest expense to deduct. no part of that purchase of the stock is deductible in current taxation. It raises your basis in the stock, perhaps. Okay. And again, the back and forth about all this is that I tell buyers to buy assets. I tell sellers to sell stock, but to expect to wind up selling assets. All right. Because it's simpler for the seller to sell stock. It's simpler for the buyer and more advantageous for the buyer to buy assets, because the other thing that happens in buying assets into a new entity is the buyer cuts off any prior problems, okay? Any prior undisclosed liabilities, any prior undisclosed claims or litigation or any of that stuff cuts off, because the seller still owns the entity that everything was sold out of. And it's up to them to wind it up for tax purposes and then dissolve it. I know we're going through here, and I'm gonna run over time. I'm sorry to say, we'll be a little bit over. So I hope you've carved out an extra half an hour or so here today. These are the tax considerations. It's another reason to have a CPA on the team. Tax entity pros and cons, that's up to you to discuss with your attorney, but recognize that these are the four major forms of ownership. A C Corp, or an unregulated, just ordinary corporation. An S corporation, which is a corporation that's been elected to tax itself as a partnership. And then an LLC, which is taxed as a partnership. There's a partnership form of organization in some states, but it's not terribly common in purchases and sales of businesses. The entity that winds up owning the assets and continuing the business is overwhelmingly one of these generally. Finally, there's the sole proprietorship form of ownership, which I don't recommend to anybody because it opens up your personal assets to business risk, the best way to put it. Now, going out and financing the deal. Financing options for buyers come from conventional bank financing. That bank financing might carry an SBA guarantee with it. There are a few direct SBA loan programs. I'm thinking of the 504 loan program. There are seller carryback notes. In other words, the seller actually agrees to be paid over time for some part of the deal, and that promissory note that you give the seller is subordinated to bank financing or institutional financing. Buyers can finance a deal out of personal savings, out of home equity. They can inveigle family, friends, and fools into investing in the business with them for small percentages of equity, or more often, lending them money. And finally, there might be an opportunity to do some finagling with a retirement plan rollover and use that to actually own the business. Now, there are some very complex rules that pertain to that, and it's up to you and your tax advisor to decide whether you can legally do that. In other words, for example, have your IRA be the owner of the stock in XYZ company. Again, there are self-dealing rules and some other things that you want to be very careful with. Now, conventional bank loans typically base what they'll lend you on the value of the asset that they're lending against, because they want collateral. They want stuff they can collect and sell if you don't pay them according to the rules of the loan. Generally, they might loan 50 to 70% of equipment. They might loan 25 to 50% of inventory value, unless it's finished, easily saleable inventory. That might bring a little higher. Receivables, which are the right to receive money from customers, those are considered a lot more collectible in general, or a lot more convertible in general. And they may lend 50 to 80% of value against those. And then generally intangible assets, things like trademarks and copyright registrations and patents and stuff like that, banks won't lend very much, if anything, against those. Bank loans typically have short and medium terms and higher down payments than other types of financing may have. Cash flow lending. Now, cash flow lending is where the bank makes a determination based on the business's cash flow more so than on its assets, but they still will take collateral for the assets. and they may lend based on EBITDA, okay? And that's the net income before interest and taxes, depreciation. It's net income after officer or manager compensation, but before any large one-time expenses. The bank does realize that the business does have to pay the operating executives compensation. And when they do cash flow lending, they will put in qualifications such as the cash flow has to be equal to 3 times debt service, or it has to be equal to 3 times or 4 times or 5 times interest expense. And the collateral still has to amount to at least 25, 30%, 35% of the loan value. Those are all covenants that are contained in loan agreements. Adjustments, EBITDA does get adjusted for purposes of calculating things like how much they'll loan you against. Some possible add backs to make it EBITDA larger include one-time legal bills, family member salaries where the family member is not continuing in the business, major non-recurring renovations, expenses for office renovations, stuff like that, things that didn't amount to capital expenditures but were nonetheless quite expensive. Employee pension plans are a possible add back. Some employers, some new buyers have come in and in effect terminated the existing pension plan, converted it to annuities for the employees, and then gone forward without offering a pension option to employees. One-time consulting fees, for example, legal fees and consulting fees in getting ready to do a deal. Major marketing productions, non-recurring type things that include stuff like new product introduction expenses and things like that. They might get added back in calculation. But it's unlikely that you would add back things like phone expense, auto expense, insurance, adjustments to cost of goods sold for inventory expenses or variances. It's unlikely that you would add back personnel reductions to EBITDA. You wouldn't add back trade conference costs. That's for some businesses an irreplaceable part of marketing. Similarly, you wouldn't add back associations and dues because the business needs to understand how its marketplace and its environment is changing. And it often will join an association, pay dues or pay subscriptions for magazines just for that purpose. All of these are negotiable in a deal as to how you're going to arrive at EBITDA for the purposes of calculating payments or valuation or price or anything else. Now, the add backs work the same as they do with valuations. You might add back something to EBITDA in the valuation arena. Same thing would happen in the negotiation arena. Now, the buyer and the seller are going to have to tell each other things. The seller is going to have to say a lot about its business, and the buyer is going to have to prove that they have the financial capacity and wherewithal to A, buy the business, and B, operate it. So buyers are going to have to complete loan applications with their lenders. They usually will have to provide their personal tax returns for the lender. They'll have to provide a copy of the purchase agreement when we get that far down the list. And also any business tax returns and financial statements if they own other businesses. For their part, the seller would typically provide the buyer with the seller's tax returns and financial statements for the last 3 years at least, and the interim of the current year, at least up to the current quarter. The two will have to develop a purchase and sale agreement that has an allocation of the purchase price so you can calculate the tax impacts. Copies of accounts receivable and accounts payable aging ledgers. Those are important because it tells you whether customers are paying their bills on time and whether the business is paying its bills on time. An equipment list, an inventory of equipment so you know what tangible assets you are buying. A copy of existing lease agreements. Copies of the most recent W-2s for the workforce for the preceding year perhaps. And also detailed evidence for any and all add backs that are going to go to increase the calculated price. All those things need to be shared between the buyer and the seller. And for that reason, you might actually have a more complete confidentiality agreement. Plus, what you'll have to do is any other due diligence documents that the buyer or the seller can think of and there are checklists of these things available over the internet and places, and you can look at it and decide what you need and what you don't. Now, negotiation. First of all, the step that starts this all down the road to closing is to negotiate what I call a letter of intent. It's a common LOI. It's a common tool in the mergers and acquisitions and business buy-sell world. And that letter of intent basically structures out the business deal. Okay, what am I going to pay for this business? How am I going to pay it? When am I going to pay it? Who am I going to pay it to? All right, that's the business side of the deal. Now, two other things that go into the letter of intent include a no shopping provision in which the buyer says, I'm about to spend a bunch of money for my acquisition team to go into your business and do due diligence. And in return for that, I don't want you to sell this business to anybody else or even advertise it for sale to anybody else. And if somebody else comes along and makes you an offer, you can't take that offer for the term of the no shopping provision. Usually that's a term that lasts for anywhere from 3 to 4 months. All right. And that's important. Another term that's important here, we talked about confidentiality earlier. There'll be a more formal statement of confidentiality in the letter of intent that will be a binding provision of the letter. The deal structure, the price, and the terms are all subject to a final purchase and sale agreement, a definitive purchase and sale agreement. This is the one that you sign that says we're doing this deal. Okay. And that definitive purchase and sale agreement will have had lawyer involvement in it to make sure that both sides' interests are protected through the closing and beyond, right? Whereas with an LOI, your lawyer might have helped you structure the LOI you're going to submit to your target, but the other lawyer hasn't seen it, okay? And this is just a recitation of the offer, the buyer's offer to buy the business. And usually it's after some level of discussion with the seller about the business deal that's being done. Now, should you do this yourself or have a representative assist you, or a representative represent you to the seller, to the buyer rather, or the seller, either way. And that representative could be a lawyer, it could be a broker. Now, on the one hand, a representative could help reduce the emotional attachment that the seller has to the business. Also, a representative's market advice and experience can be helpful in, again, bringing experience to the deal. We're only going to, you as the buyer or you as the seller might only do this once or twice in your life, unless you're a serial entrepreneur. All right? So keep that in mind. The deal structure includes a call out of the stock sale versus asset sale, the basic dichotomy. It identifies the assets being sold and purchased. It identifies any required outside financing and will carry a financing contingency, okay, which needs to be satisfied before closing. It will have consulting and non-compete provisions. Common to deal structures is a structure where the buyer pays something at closing, they pay on a promissory note to the seller, they pay on a consulting contract to the seller for the seller to be available to them afterwards, and they pay for a non-compete provision so that the seller doesn't move across the street and open a competing business tomorrow with what they just got from you for this business. Any earnouts, so-called contingent payments, will be called out in a deal structure. Indemnifications will be called out in a deal structure. Transition and training periods will be called out. And then a general guideline for the timing of getting the deal done will be called out in that letter of intent. Now, the timing of things may change, may have to change, but there may be the need to do something by a certain date, in which case the legal term time is of the essence will be used, which means you get it done by that date or it's dead. So keep that in mind. Now, due diligence is the process of proving what's been represented in the deal. It goes both ways. The seller does due diligence on the buyer does due diligence on the seller. If you are well prepared on both sides, that means you can do this in less time. And less time is golden, because a deal delayed is a deal endangered. The seller wants to verify the buyer's capacity to close the deal by reviewing bank and brokerage statements of the buyer, and also by reviewing financing commitment letters the buyer will have gotten from its lenders. For the buyer's part, the buyer wants to confirm all of the representations made by the seller in the information memorandum, and also to make sure that the legal, financial, and operational aspects of the business are as they have been represented. They want to verify that the business, if real estate's involved, does own the real estate, that the equipment is owned, that the inventory is owned, that all of the assets, tangible and intangible, are in actuality titled to the business that is selling them. And if they're not, then the business that is selling them needs to have whoever the owner of those patents and trademarks and logos and real estate and equipment has to have that individual be a party to the sale. Buyer due diligence, on the legal side, title transfers, assignments of leases, creditor approvals, EPA and other regulatory issues, pending or threatened litigation, unasserted claims, undisclosed liabilities, the seller's capacity to convey the business, and any other legal issues get examined through the lawyers. Operational issues get examined generally by whoever the buyer is going to have as its primary management person on site. That's usually the buyer himself or herself, but it could be a buyer's executive, okay? If a large corporation is buying a smaller one, it's unlikely the CEO is going to be doing due diligence. It may well be left to a lesser executive or their staff. You're going to want to verify that the staff are in place, that they're going to stay. You're going to want to verify the organization, the products and services that they put out, the processes they use, that they have rights to the technology and processes that they're using, and also to get an information about the condition of the assets. You may go through it with an asset appraiser or an experienced engineer or mechanic who can assess the condition of what you're buying from a machinery standpoint. Finally, you're going to want to do a competitive analysis from an operational standpoint, just to make sure that what was said in the information memorandum, the information package, what was said is correct. Finally, verification of the and confirmation of the price and terms. That's usually done in a purchase and sale agreement. The tax structure, that's addressed in a purchase and sale agreement. You're going to want tax opinions from your CPAs about, yes, this is the proper way to treat this for tax purposes. Any third-party financing is going to be verified by the seller. Third-party appraisals were going to be gotten by the buyer. The purchase price allocation is going to be ascertained between the buyer and the seller so that you're both on the same page. How much of the purchase price is for tangible assets? How much of the purchase price is for intangible assets? How much of the purchase price goes to a consulting contract? How much to a non-compete agreement, and so forth. And then finally, the due diligence will verify and call out who's responsible for fees and expenses of getting the deal done. The typical purchase and sale agreement says whatever fees and expenses each side has incurred, they're responsible for them out of the proceeds of the sale. Nobody is paying anybody else's fees and expenses from either side in this deal. That's the commonest way to go about it. And due diligence is important to complete quickly because, again, if the more you delay, the more people can have second thoughts. Now, from a non-financial standpoint, due diligence includes determining and verifying or confirming the business's reputation and its market position. It's verifying that there are management agreements in place. You may want to enter an employment agreement with key employees other than the owner to keep them in the business and keep them happy in the business. All right. Key employees who feel neglected in a deal or exposed in a deal with no assurance that they're going to continue with the business, they may just go looking for greener pastures quicker, sooner rather than later, even before the deal closes. So you're going to want to be very aware of that and sensitive to it. You want to verify that any customer and vendor relationships will transfer with the sale. In other words, that the biggest customer isn't the owner's son-in-law, or father-in-law or brother. You're going to want to know that the key vendor relationships, that they are third-party arm's length business relationships and not somebody's brother-in-law or cousin or whatever. And then finally, in non-financial due diligence, these are two questions that you ask early in the process. One is, can you do or learn to do what the business does if you're buying it? And second of all, how can you improve that business? It's worth to them what they made of it. It's worth to you what you can make of it. How do you go about improving it so that you make it better? Because that will improve the cash flow that you have available to satisfy all those claimant relationships that we talked about. Lenders, Uncle Sam, finance, other financing, all of that stuff. And improving the business so that you profit from it, which is presumably what you want to do at the end of the day. Now, closing. We get to closing by drafting and finalizing the purchase and sale agreement. This is the legal deal. When you sign on the dotted line, you are committing to buy or sell the business. You choose the entity type and create it so that you can buy the business's assets. Usually it's an asset sale. You can buy the business's assets into this new entity. You set up the new entity's books. You get all the what I call administrivia out of the way. You get an employer identification number. You get a gross receipts tax number. You get workers' comp insurance. You get other insurances that you need. You set up your banking operations. Set up your payroll operations. And typically in a business, there's a true up, it's called in the contract, where at the date of closing, there will be a final inventory count and valuation, or that will take place at some date within a few days of the closing. And there might be an adjustment to the price up or down based on whether there's more inventory or less inventory on hand than was considered when the deal was struck. Okay. There will be conditions in the purchase and sale contract intended to protect both sides. Those conditions all have to be fulfilled. There may be an escrow agent or an escrow attorney involved to hold money and hold documents if the two parties aren't coming together at a conference table. Most of the deals I've been part of, the two parties came together at a conference table in a lawyer's office and spent a day signing papers and making sure that everything that needed to be done was done. And that's details, details, and details. Sometimes the buyer and the seller can't be in the same room. The buyer's in California, the seller's in Florida, and an escrow agent or attorney may collect all of the necessary paperwork from both sides, verify that that's the paperwork that's required from both sides, and then release the documents and the checks to the other side of the deal. It's details, details, and details. It's stock certificates and transfers, asset bills of sale, lease assignments, personal guarantees signed by the buyer, checks from the buyer, checks from the lender. It goes on and on and on. And this is another reason why having an attorney with some experience in the process and or an intermediary with experience in the process is vital to the success and the smooth completion of the deal. Now, post-closing, there may be a working capital true up, not just inventory, but maybe receivables were agreed to be a certain level at a certain point in time. There'll be training by the seller of the buyer. There'll be integration of the seller's operations, the sold company's operations, into the buyer company's operations. There'll be the collection and payment of seller financing. There'll be the calculation and payment of any earnouts, any contingent payments. It's very common in a deal to say, I will pay X dollars more if we do Y more business in the first X years, Z years after the deal, right? And finally, you want to keep an eye on monitoring any of those provisions of the deal that require post-closing monitoring to make sure the deal stays the way it was supposed to be. Now, we are over time by about 15 minutes, but I do want to address any questions that anybody has been saving up. I don't see any in the Q&A queue. If I open the chat box here, I see that we do have a couple of questions in here. Yes, you will. Sandy Jones asks, will we get a copy of the slides? Yes, you will get a copy of all the slides in full following this. You'll also see a survey coming up at the end of this that I do ask you to return because it gives me ideas on how to make this presentation better. So I'll give you a few seconds to write down your questions if you would. Um, as they pop up, I'll take them and answer them live. By the way, feel free to submit written questions after this webinar is over to Jackie or the NMSBDC folks. The email address I think is info@nmsbdc.org, and they'll pass them on to me and I can answer them in writing as well. So that's
Thank
the,
you for that. I'm also going to put in the chat here just some important links and things that they can go over.
okay. Yep. What I suggest, folks, is that you take the chat and you can copy and paste into a Word document or something. The chat will disappear, of course, when the seminar is over. So if you want to keep those links and references to pages and stuff like that, don't be afraid to just copy it out onto a blank document so that you can do it later. And if we don't have any questions popping up, I will say thank you very much for your time and attention. I appreciate it greatly. There are some things in the slide deck that you may find useful other than just what we've talked about today. There's a page on COVID-19 business resources from available through NMSBDC or other links that are noted there. I'm not going to go into them in detail. And also you can go to nmsbdc.org for further training, business counseling, loan application assistance. They have links to a variety of other resources. Also, you will receive a survey request after this presentation. I do ask that all of you look closely at it and please respond. It helps me to improve the presentation and it helps SBDC to understand how well we got through to you with all of this material. You've been drinking from a fire hose for an hour and 15 minutes, but guess what? It's over. It's the end. I thank you for your attendance and for your participation and wish you all the best going forward to buy or sell your business.
All
Good
right,
afternoon,
and with
everyone.
that, I want to say thank you for the presentation and valuable information, Tommy, and thank you to all of our attendees. I wish you all a great afternoon.